about it this way. Right now, school is what's important. You have to live, I do understand that. All right? But make normal living, eat, sleep, the work you have to do at home, the work you have to do on the job, and school, those are the most important things. All right? So, you can do this, you are here. You're at level 3. All right? You're at level 3, so you have come through all of the levels. All right? And you're at 3. So it means that if you're here, it means that you passed a lot of courses already, right? So you've done well. And you can take that to finish up. Those of you finishing up, you're gonna get there. All right? You may not, not everything may come out the way you want it. You may get an A minus instead of an A, that's what you're shooting for. Shoot for the A, or the A plus, right? And just know that once you can tell yourself you've tried your best, that's what's important. But you can't tell yourself you tried your best when you didn't try. So you have to try. All right? And Dr. Gittins is not here to fail anybody. So. And once you attempt every question, you will get marks. You attempt it, you've been here, so you should remember something. Yeah, something? And the thing about these courses, at least the courses I teach, information from a course you did before can help you in what you're doing now. All right? So, all right, we are winding down. Okay, just the fact that you've seen that first draft of your exam timetable, by the way, I haven't seen it, huh? So I'm clueless. I'm just going from some students telling me yesterday that I need to say something to exams because, anyway, I'm sure I will see it in the next couple of days. When is it that this exam is?
The 2nd of May.
2nd of May? Okay. Y'all finishing early this year, realize? Finishing early, because we should write. So we're winding down. We're winding down. How's it winding?
No, we finish it early.
Exams finished, exams started early. Yeah, exams start 20th, somewhere there. Finish by mid-May, finish. All right, so we are moving along. I trust that Mrs. Brown Joseph was able to go over the examples again with you because I asked her to go back over them because I got the sense that people weren't settled. You didn't quite get the translation exposure. All right? So I'd asked to go through that with you. We'll still have some time for review. If we are not able to cover everything in class, then in that week that you have off to study, if you want to do an online review session, I'm open to that. The only thing with that week is I have a conference. That week that you have to review, I'm going to be in a conference for a couple of days.
So you're going to say
But
study days
the evenings I should be free. Huh?
You'll give us study days. So tomorrow.
I don't like to give study guides. You know why? Because the courses are of such. I may tell you you're going to get this topic, and this topic. but then the topics build on each other, right?
That's true, but
So,
I mean, you know what's a narrative.
so because the topics build on each other, you may have a situation where you tell me, I ask you a question, so I may say to you, you're not going to get chapter 1, which is about globalization and so on, right? But a question on exposure. The reason there's exposure is because there's globalization. And you may have to draw on the knowledge you have on globalization to answer the exposure question. Because remember, Dr. Gittins not going to ask you specifically what is globalization and what is exposure. I'm going to ask you a question where you have to apply those principles. As a manager of a multinational firm and you are faced with this situation, what would you do? That's the kind of question that I would ask. All right? You can get a question with economic, translation, and transaction exposure all in one. Okay? Because in this course, you are learning how to manage a multinational firm. Okay? You're learning all of the aspects that come into play with managing a multinational firm. That is why it's called international financial management. Because you would have done financial management where you're making decisions about how you finance your business, how you manage the money that you have. All right? That's your financial management side. International financial management side takes in all of the other things that you now need to take into consideration. Right? So we're moving on, like I said. Seeing the slide up, I'm going to increase the size so it's a little easier. And what I realize is sometimes the slideshow sometimes makes it worse in terms of the ability to see. So I'll leave it like that. And of course the board needs a good cleaning, so. Right. So we are going to be looking at, in this session, we're going to be looking at pretty much international markets, international financial markets, right? Now, for those of you who didn't do portfolio management, it may be a little more difficult to understand, but if you have done elements of banking and finance, I know you have done it, most of you have done it a long time ago, it draws on some of that. So that would have provided the base for this, as well as your financial management. So when we talk about international financial markets, without me discussing or even talking about it, what do you think that is about? Don't look at the screen. Think about what are financial markets? What are financial markets? We did it in elements of banking and finance. You see the hand up? Or you just stretch it?
Financial instruments, stocks, bonds.
Right? Just a place. Just a place. Just a place where they sell is international. So a domestic financial market means a market where you sell securities in the domestic space. So internationally, what are we talking about? What's international? What does that suggest? There are markets worldwide, all right? There are financial markets worldwide. And because of globalization, what do you think has happened with these financial markets worldwide? What do you think has happened with globalization? Huh? What happens in one market tends to affect the other, all right? And so right now, anybody can tell me what's happening in the financial markets? The U.S. financial market in particular, the market looks like it's about to crash, right? Yeah, it has declined significantly. Why is that?
Because of the tariffs.
Because of the tariffs, let's identify, okay, that's specific because of the policies of one government, yeah? We can almost say because of the policies of one man, because it will appear that he not getting any guidance on these policies. He seems to be just talking off the top of his head, right? That's how it comes across. But I trust that he's getting some form of guidance. Okay? So, but what we know is his policy right now is to place tariffs on Canada, Mexico, China. So he has placed those tariffs. Those tariffs, what do those tariffs mean for multinationals in the US and multinationals in those countries? You know this, we just did it. It's a good time to be doing this course, but it would increase their costs, right? And so as a manager of these multinational firms, what would you be looking to do now? What would you be looking to do now? Source materials from different places. Yes, because you want to bring your costs down. Good, okay, so you learned something in this course. Wonderful. That's why I say it's a good time to be doing this course. You are seeing the application of what you're learning firsthand. But some multinationals, they will try to source products elsewhere, but what could happen is that those products, they could source them from elsewhere, but maybe just the transportation costs, all right, so for Canada, if they source it from the US, the transport, if the US sourced it from Canada, the transportation cost would be much less, and maybe the transportation costs and the tariffs is still less than them sourcing it from maybe China or Europe, right? So they have to assess that. Now, what has happened, Trump set the tariffs on these countries. What have these countries done? Retaliate. All right? So the entire international market is going to be affected because not only has Canada, China, Mexico retaliated, who else has retaliated? Europe and the UK. They are in support of the other countries, and so they are also saying that they are going to put tariffs on US goods, right? So we have that situation. Now, because those companies, their costs are going to increase, what's the knock-on effect from that? If costs increase, then what happens? Prices will increase, but what has happened? If costs increase, profit will decrease, right? So the profits will come down. When the profits come down, what happens? Well, what happens when your profit come down? You can't spend as much. So there could be a recession, yes, but what's the effect on the market when the profits are down? The market is going to fall. The stock prices are going to fall, right? So in looking at the international financial markets, what we're focusing on here is really where do these markets exist and how they function, right? But it's important to understand how what's happening in the US right now is affecting everybody, affecting all the multinationals, affecting not just the multinationals, but affecting the stock market. Going to affect economies, will it affect the US economy also? Now, Trump's policy is, all right, he's saying it's tough, it will be tough now, but it's going to reform the economy. Okay? And he has a point to some degree because how Americans spend, all right? How they spend, what they spend on, how much they spend is what is actually driving the economy. In terms of the markets, a lot of the companies are overvalued. Their financial fundamentals do not support the price of their securities, right? So what would happen is that there's an adjustment. And so I think over time, you may see the stock markets, it will settle, you know, it will eventually settle. So you're gonna have the declines, but it will eventually settle and bottom out. And then they will have a new normal, right? That said, let's have a look at so we're gonna look at the international equity markets, all right, stock markets. We're going to have a look at the international bond market, and we're also going back to derivatives, all right? Okay. To do that in a little bit more detail, and however, you've done the tough part of the derivatives already, all right? So, most of the significant major equity markets are in the developed countries, all right? So we are talking about the United States, the United Kingdom, Japan, France, Germany. Those are the main centers in terms of well-developed, deep equity markets, all right? So the point there is that there are 30 developed countries. However, in terms of equity markets, it's concentrated in just a few, being the US, the UK, Japan, France, Germany, right? The other countries also have equity markets because we have us in the Caribbean, in the OECS, all right? We have equities that are traded on the Eastern Caribbean Securities Exchange. Jamaica has its stock market, Trinidad has its stock market, Guyana, Barbados, Belize, Bahamas, they all have their markets, right? The other large countries, so India, China, Brazil, Africa, they have their markets also. Mexico, but their markets are considered to be emerging markets, all right? Emerging meaning they don't have as much stocks trading, okay? Their markets are not quite as liquid, and their companies are still developing, all right? But these other countries have had markets for many, many years, okay? So not to say that the countries don't have markets, they do, but the major ones are US, UK, Japan, France, and Germany, all right? Of course, we know when we hear about the stock market, we usually hear about the US stock market because that is the news feed we get, that's the information we get. But the UK, Japan, France, and Germany, their markets are well developed also. So that's the largest market, and it's the largest market because the most shares trade on the US markets, right? According to the text, it's more than triple the other markets. And so, around the world, investors invest in the US stock market. So they will invest in their own markets, but they invest heavily in the US stock market, all right? So even companies within our Caribbean region they invest in the US stock market to get extra monies, to make money. All right. So I said, I spoke about the emerging markets already. So those emerging markets, they are located in low or middle income countries, right? So Latin America, Asia. So in Latin America, you have Argentina, Brazil, Mexico. You also have, in Asia, you have China, Korea, Taiwan. There's also Singapore. Australia has its financial markets as well. New Zealand, Australia, and so on. The emerging markets, you'll see them here as Latin America and Asia. Australia is not considered emerging. It's considered a well-developed market. But these ones that you see here are the ones that are considered as emerging markets, right? And what would have happened in the Mexican crisis, the Mexican peso crisis, and the Asian crisis is that because of the foreign currency crisis, all right, those companies or investors that invested in these markets, they would have taken a hit, and so they would have pulled their money out of these investments, and that is what would have made the crisis, the Mexican peso crisis and the Asian crisis that much more negative for the countries. The investors came out, they made some losses, but it affected the value of the currencies, right? Because if they're purchasing securities from these countries, it means that they need the currency to purchase. And so the demand for the currency would be high. So if they're pulling out, it would reduce the demand for those currencies. Now, any market, any well-functioning market should provide liquidity. All right? Liquidity meaning you are able to sell if you purchase stocks, you are able to sell those stocks quickly and at competitive prices. So that's what liquidity means, okay? So hence part of the reason the US, the UK, Mexico, not Mexico, sorry, the US, the UK, Germany, France, Japan are considered the major markets. Canada also has its own stock exchange, its own market, and heavily traded, but is not considered a major market. It's liquid, all right, but not considered as a major market. So a liquid market provides investors with the opportunity to trade stocks quickly at close to the current quoted prices. So it's not just that you can sell your stocks, but you can sell your stock at a competitive price that is the price across the board. All right? The way you measure liquidity in a stock market is the turnover ratio. All right? Turnover ratio meaning the ratio of the transactions that take place divided by the size of the market. So the transactions that take place over a specific period of time divided by the size of the market is what gives you your market capitalization, all right? And that is how we measure the liquidity. So anybody knows the market capitalization of the US, of the US, of the, let's say, the New York Stock Exchange? Google it. You're allowed to use Google and ChatGPT for things like that. Copilot.
You can repeat the question.
What is the market capitalization of the New York Stock Exchange? Approximately.
28.33 trillion as of July 2024.
20. That is good garbage. Doesn't work. 28.33 trillion. How much? What you
What's
said?
up?
I have 32 trillion. So.
Pocket change.
32 trillion. But I suspect what Rashidi is giving us is what it is now. Rashidi?
No, I
No,
said
that's what I said.
2024.
Or July 2024?
This is January 2025.
2022. Oh, okay. 2025.
What was
That's
it yesterday?
Yesterday.
Do they have that data point?
This is for 2 days ago.
2 days ago. So January 2025, 32 trillion. Let's work with 32 trillion. Think about that. Can we even imagine what 32 trillion looks like? Huh? What are the truckloads? Plenty. So, in other words, with all of the shares trading on a daily basis, all right? That's how much money is going through. That's how much money is passing through, right? When you have several companies that have market capitalization of 10 billion or more, you can understand how we get to 32 trillion. But remember that that's the New York Stock Exchange, right? Remember, it's triple the others. Okay, so that sort of gives you a sense of what the volume that goes through. Check for me what the London Stock Exchange is. So this is the New York. What's the London Stock Exchange? I believe that one is called.
3.42 trillion.
what?
Wait, no, that's as of July last
64
year.
billion.
64 billion is what you got?
Yeah.
Okay, but as of when? That's dollars or pounds?
Pounds.
Okay. All right, and even if you were to convert that to US, it would not reach 32 trillion, right? So, when you look at the volume of the market capitalization, the volume of trading, the liquidity, the market capitalization, talking about the same thing, you understand why it is easy for someone to sell and buy securities at will, all right? So you can purchase a stock today and sell it by the end of the week and make money if you have made good decisions about the stocks that you invest in. In the market currently, you may not make money, all right, because of the situation right now. Because generally, when the market as a whole is doing well, individual stocks will do well. When the market as a whole is doing poorly, individual stocks will do poorly, right? So let's talk about a little bit more about the market. So you have the concept of market concentration. Market concentration really means that there are a larger volume of stocks, not, when I say larger volume of stocks, the variety of stocks traded. So in a concentrated market, you're able to diversify your portfolio better, all right? In portfolio management, you reduce your risk by diversifying your portfolio. What does that mean, Shabo? I know you didn't forget.
You spread out
Diversification means you're going to do what? You're gonna buy more stocks, all right? So not more of the same stock. You're going to buy several different stocks, all right? From from different industries, and that is going to reduce your risk while still giving you a good return, okay? Now, you can further diversify by investing internationally, okay? So a market, the more concentrated the market is, meaning the more companies that trade in the market, the easier it is for you to diversify your portfolio. So when we bring all of the markets together across the world, the major markets as well as the emerging markets, it provides the investor with the opportunity to diversify and bring the
Makes
risk
sense.
down. All right? So differentiating the markets, you have the primary market where you sell securities for the first time. So a company that's selling its shares for the first time will be selling in the primary market. All right? In regards to the bond market, a new issue of a bond is in the primary market. All right? A market gets its liquidity because it is able to sell, resell, all right? So the primary is where the securities are sold initially or first, whereas the secondary market provides you with the opportunity to buy and sell your securities. So you'd have purchased and you can sell them. When you sell them, you're selling in the secondary market. All right? So the secondary market is where you're selling securities, buying and selling securities that have already been issued. All right? That secondary market provides a market for you. So it provides marketability, one, and two, it allows you to be able to value your shares that you purchase. It provides that valuation for you. Rather than you going and trying to figure out how much I should sell the security for, because the market is there, there are other people selling as well, other people buying, and so there's a price, all right? So you are not just going to come up with a price for your stock willy-nilly. So I'll give you an example. There's a spot on my glasses that will not come out. And it keeps every time I look up at it. So there's a particular financial institution in Antigua and Barbuda, all right? It has owners, it has shareholders, right? But it's not a public company. And so when a shareholder decides that they want to get rid of their shares, which hardly happens, what the shareholders in these private companies tend to do is to sell to each other. They tend not to go out, or they sell to a family member. So they sell within that body of shareholders or to a family member, because they're trying not to dilute their shares, right? However, if it became a public company trading on an exchange, the institution would get a lot more capital to work with, right? So with that private company, the owners of the shares in the private company can decide that they're going to sell a share for $20 a share. Company may not be worth $20 a share, but if you want a stake in that company, you have to pay whatever they say it is. Whereas a public company that trades in the securities market, the market is going to tell you what the value of your share is. All right? And the value of your share is not just dependent on your financial fundamentals or your economic fundamentals, but the value of your share also has to do with what the market thinks your shares are worth. right? So that secondary market provides marketability and share valuation for those securities that have already been issued. So generally, at that initial public offering, that is when the shares are offered, they're going to offer them at a particular price, and in most cases, the share price will just go up from there. All right? If the company, of course, over time is not doing well, the share price will come down. Okay? So there are people who sell in the market. The people who sell in the financial market, buy and sell, are known as brokers. Okay? And they make what you call market orders or limit orders. So a market order is executed at the best price available, all right, when the order is received. So if you would like to purchase some securities, the broker will just execute at the best price for you. However, if you have a limit order, all right, that limit order, you're going to tell the broker what you would like to pay for it, all right? And so they will hold that order for a while until they can get the price. They can get it at the price that you are asking for. So that's so the market order, they just go into the market and they get the best price they can get for you. The limit order, you tell them what you would like, you can give them a range, and they will hold on to that until they can get it at that price. Because what the broker is going to do, they are traders who have an inventory of stock. The broker is going to go to a trader to see if he or she can get the stock at that price. So what we're looking at here is really how the market functions. Okay? So just the keywords, the basics about how the market will function. You have I mentioned traders, so the broker will buy from a trader or a dealer, all right? A dealer in a dealer market is a market in which brokers trade through a dealer, and that dealer acts as a principal, and they buy and sell the securities for their own account, all right? So the dealer is the correct word. I am using jargon that I'm accustomed to because many years ago when I would have worked in investments, we had specific traders that we dealt with, but they are really dealers. They have their own inventory of securities that they buy and sell. Then you have a dealer market, you also have an agency market. And in the agency market, there are agents through whom the broker will take orders for the client. So instead of the client going directly to the broker, the client goes to an agent and then the agent deals with the broker. All right? So it all depends on the market and how it works. So usually individuals would go to an agent and the agent deals with the broker. And institution would most likely have their own brokers, right? So a company would have a broker that they use, and those brokers work for investment banks. All right, remember elements of banking and finance? Right. And, you okay, Darwin?
It's just that last phrase, through whom the broker takes orders from his or her clients.
Right, so some clients would not go directly to the broker, right?
Okay.
So me and you may not go directly to a broker because of the size of the market, right?
Mm-hmm.
We have an agent who works on our behalf.
Right.
It's like our wholesale retail trade, right?
Okay.
So the wholesale, there's an agent,
Mm-hmm.
all right, who relates to the retailers.
Okay.
Okay?
Mm.
But just that in the market, there are brokers and there are agents.
Okay. And the agent goes to the broker.
Right, so the agent works with the broker,
Okay.
okay? And the broker will work with sometimes the broker works for an investment bank who has their own set of dealers. So in that industry, you will have the large investment bank that has everybody. So they have the broker, the dealer, the analysts, all right? They'll have everybody in there. But there are some smaller agencies that have agents, all right? Within our region, we have the investment houses in our region. We don't have here, but in other islands, they're considered brokers. They're brokers or agents, all right? Those brokers may have small amounts of securities for their own account, so they may purchase some bonds and they will have that for their own account because they're invested as well. And so they may sell you from their account. But mostly you go through the broker and the broker will put in your bid in an auction.
Okay.
Right? That's for bonds. For stocks, they would go to the exchange to see who is selling. Right?
Okay.
Then you have what we call an over-the-counter market. The over-the-counter market is a dealer market. Why is that? Because the dealer has their securities. They have an inventory of securities which they can sell. They don't have to go to the exchange to purchase. Right? And so you have some examples there. You have the National Association of Security Dealers automated quotation system that's called NASDAQ. I'm sure that you have heard of NASDAQ if you're listening to the American news. Jaheen, NASDAQ? Okay, good. Chabo? All right, my portfolio management students should know these things. So the NASDAQ is a computer-based system that shows the bid and the ask quotations for all of the dealers that that deal in a particular security. All right, so that's an example of a over-the-counter dealer market. The American Stock Exchange, the New York Stock Exchange, those are organized exchanges in the US. In the UK, you have the London Stock Exchange, all right? In Japan, so you have the different stock exchanges. The exchange markets in the US are what you call agency or auction markets. So you have stocks, there's a specialist who will, or the dealer who will hold an inventory of the securities and you go through them to purchase. The New York Stock Exchange, it's a physical market, all right? So you have physical markets, you have electronic markets. So you have the physical market where you actually go on the trading floor and you buy and sell. You put in your bids to the dealers and do your business. The electronic markets is online and you will put your bids in through that. So the over-the-counter and the exchange markets, they are continuous. So even if you don't get your transaction dealt with today, you may get it dealt with tomorrow or the next day. All right? So the limit orders can be executed anytime during the business hours. However, so that's for in the US. For the electronic markets, you can trade 24 hours. All right?
Okay.
So what you call a call market, the agents will accumulate the bids for the various securities they're selling, and then they will execute at another time. Non-continuous trading is done in the call market. Non-continuous meaning you're not buying and selling all the time, you're accumulating and then you're going to sell. All right, so you accumulate the batch orders and then you execute over time. So it's not where you keep doing it, you're going to pull them together, and then you will execute at intervals throughout the day, right? Then you have something called crowd trading. That's non-continuous trading as well. And again, it's like a bunching of orders together, and then you trade. So that's how the market, how you purchase. All right. Now, how you monitor the market to see how the market is doing, you would use an index or a benchmark. An index becomes a benchmark. All right. So you're going to monitor the performance of your portfolio against a benchmark. What is a benchmark? It's an index or a group of securities or stocks that are traded on a secondary exchange. So you hear about the Dow Jones Industrial Index. You hear about the S&P 500. So the Dow Jones is 30 stocks. That's 30 stocks, all right? S&P 500 is as it says, S&P 500 stocks. Then you have something called the Russell 2000 Index. It's 2,000 stocks across 2,000. So there are different indices that you can use to monitor the performance of your portfolio,
Okay.
right? And when you use the index in that way, it's a benchmark. A benchmark tells you how the market is performing. And so when we talk about the performance of the market on a daily basis, they're looking at the performance of the indices, because the indices represents a group of major stocks. So if you were to Google the stocks included in the Dow Jones, somebody do that for me quickly, so that you get a sense. It's 30, so you get a sense of what we're talking about. Huh?
They said,
The Dow Jones Industrial Index. Ask how many stocks are in the Dow Jones Industrial Index. But there are many, many other indices. But the Dow Jones, the Russell 2000, the S&P 500, those are the most popular ones that are used, to represent the U.S. stock market. Other investment houses have their indices. So you have the Morgan Stanley Capital International Index. So the Morgan Stanley Capital International Index, that includes not just U.S. stocks, but it also includes stocks from other countries. Dow, 30, what are they? Coca-Cola, McDonald's, Visa. So for 1 second, Coca-Cola is beverage or beverage. McDonald's, food. Visa, financial. Boeing, airline. Caterpillar is construction industry. Chevron, that's oil. Cisco is what? Tech. ExxonMobil, that's oil again. Disney, that's entertainment. Goldman Sachs, financial. So we get the point, right? The indices represent a cross-section of industries or companies in a cross-section of industries, right? And so it tells you here the indices generally include equities or stocks that represent at least 60% of the market capitalization of each industry in the country. So that's why we have finance, we have retail, and I'm sure there what are some of the other retailers? Well, food and beverage, McDonald's and Coca-Cola is food and beverage.
We have Nike.
Nike, okay, that's considered retail. Walgreens, yeah,
I think it's a Walmart.
Yeah.
yes. So Walmart would be, right? So you get a sense of what the index is. And then there are those you can actually purchase, all right? They have exchange, something called exchange traded funds, all right? Or exchange traded fund or mutual funds. You can invest in a mutual fund or an exchange traded fund and still have the advantage, get the value you get from investing in the individual stocks. But when you don't have a lot of money, you would invest in, let's say, a mutual fund to get the diversification and still have the benefit of making some money on investments. So investors that trade internationally, they get the benefits from international portfolio diversification. So in other words, diversification means you're not putting all your eggs in one basket, and so your risk becomes less. Okay?
Unless you want it to be risky.
Unless you want it to be risky.
Right, right.
Now, with globalization, you have the liberalization of capital markets, right? Liberalization of capital markets, what's happening there is that you have the different regulators of capital markets across the world. They sort of harmonize their regulations. So they request the same things, they have the same requirements in terms of financial that you have to submit. And then there are rules where you can trade. So with globalization and the integration of markets, you have the relaxation of the regulations. That relaxation of regulations is a double-edged sword. It allows the investment, but if you are not prudent in your management of the portfolio, you can end up losing money, all right? Because of the same globalization where what happens in one country affects the other, all right? Also with the improvement in technology, computer and communications technology, we can stay from here and purchase overseas and vice versa, all right? Companies cross-list their stocks so that they're those companies that their stocks will be on the New York Stock Exchange, listed New York Stock Exchange, but it may also be listed on the London Stock Exchange, the Japanese Stock Exchange. All right? With the cross-listing, the companies, of course, have a wider base of investors to choose from, but with that cross-listing, what will happen is that the shares become diluted in the sense that you as an investor won't have as much say, right? So cross-listing it's helpful to the company in that it increases the market, all right? For the stock, you have more investors, and usually you have an increase in the demand for the stock, all right? It gives your company recognition across capital markets, so your company becomes more popular, your products become more popular, because if you know the name, you're hearing a name, all right, then you would tend to gravitate, you're gonna go and investigate to see what does that company make, you know. You may want a piece of the pie. Right. So cross-listing helps to do that. The cross-listing could also reduce the chance of a hostile takeover of a firm because you have more investors rather than investors concentrated in just one area. Hostile takeovers do happen, all right, because what happens is that, remember, investors are not just individuals. Institutions invest as well. And so you can have a hostile takeover where institutions come together and, or sometimes even a single firm may have a significant number of shares in another company, and you could have a hostile takeover of the company. hostile takeover means that you have been acquired without your desire to be acquired.
Mm.
All right? Now, so we know that stocks are cross-listed, all right, on multiple exchanges, or
Right.
stocks, and a US company can decide to list on a foreign exchange. There's a mechanism for that, all right? So foreign stocks are traded in the form of what we call a depository receipt. So in the US, you have, the US stocks are, the ADR, or the American Depository Receipt, is stocks that are issued on the stocks are, let me start over.
Go ahead, sorry.
So the American Depository Receipts are foreign companies that trade in the US, all right? Then you have what you call Yankees. Those are the stocks that are traded on the US stock exchanges as the American Depository Receipt. So what the American Depository Receipt does is that it's denominated in US dollars, and it can be traded through the broker. You don't have to have any special broker for that. The dividends on those shares are collected and converted into US dollars by their custodians who hold the shares on behalf of the investors, all right? An American Depository Receipt, though, that trade, if you do the purchase today, you're not gonna get it for another 3 days. So it clears in 3 business days. All right, so that's the mechanism. That's the mechanism by which you have the cross-listing. So ADR prices are quoted in US dollars. They are registered, all right? They're registered securities, so they are registered in the US and registered in order to protect the owners, all right? Most other stocks are, most of the underlying stocks are securities that, bearer securities, meaning that you own them. ADR investments can be sold by trading them to another investor in the US stock market, and the underlying shares can be sold in the stock market as well, right? And so the ADR represents an underlying equity, all right? The ADR is a piece of paper that represents the equity, okay? There are 2 types, sponsored and unsponsored. So just, this is the mechanism, the terminology used in securities that are listed on American exchanges. The sponsored, it means that it's created by a bank at the request of a foreign company that issued the underlying security. And the unsponsored, these are older ADRs. These were created a long time ago at the request of a US investment company without the involvement of the foreign company. All right, so those are the unsponsored older ones. Then you have global registered shares. Those are traded globally, and they can be purchased on an exchange. So Daimler Chrysler, anybody who knows what Daimler Chrysler is? Everybody knows the company Daimler Chrysler? How about my car buffs?
What?
Car buffs in here?
Car buffs. I know about Chrysler cars. Like
You
that.
know about Chrysler, you know about Daimler?
Never heard of that.
Daimler Chrysler, they make, everybody knows what they make? They make Mercedes Benz.
I shouldn't do that.
All right, so Daimler Chrysler shares are traded as global registered shares. All right, they traded globally. And just like domestic equities, global equities or international equities are affected by macroeconomic factors. So economic factors